Okay. So next question. What type of life insurance? You guys can see the question still? Okay. What type of life insurance is characterized by small face amounts in premiums that are typically collected at the policyholder's home? So that's industrial life insurance. Okay. Industrial life insurance was mainly designed, it's not as big anymore. We sell actually a version of industrial life insurance, final expense life insurance. Industrial life insurance is designed to just mainly cover final expenses. So it's like a few $1,000s for a face amount. It's not these massive plans. That's what we sell here. Final expense, anywhere from $5,000 to $50,000 of life insurance typically is what we sell. All right. What is the primary feature of whole life insurance? So coverage for a specified term, that's term life, right? Whole life is for their whole life. Universal life is a mix between term and whole life. So it's a term policy with a cash value component. Investment opportunity in equity markets. So an ordinary whole life, they're not invested in equities. It's invested in the company's account. So you know how with whole life insurance, it's a fixed product, meaning the interest rate and the accumulation is fixed. Some participate in dividends, some don't. But even if they do participate in dividends, they are taking part in the company's profit. So typically a life insurance company will invest in a little bit more stable investments than the stock market. So for instance, they'll invest in like up and coming countries, right? So countries that are booming industrially. So like a lot of life insurance companies were investing in India in the last 10 years or something like that because there was a lot of, the economy was growing, or they'll invest in something a little bit more stable where it's like spread out over the whole, like their investments are everywhere. They'll buy real estate, they'll buy, like built skyscrapers in New York City or something. It's never going to not be worth money. So they'll buy things like that that'll bring income, and their investments are a little bit more stable. If it's a variable whole life policy, then you can invest in like specific parts of the market, like equities, which is stocks. Coverage for the insured's entire life with a savings component. So the savings component, this is why it's whole life, because they're covered for their whole life and they have a savings component in the cash value. So cash value is just an accumulation vehicle of it's like equity in a home. Term life is like renting, whole life is like owning. Okay. And then flexible premium payments, whole life does not have flexible premium payments. It's the same premium. Which policy type provides a death benefit and also accumulates a cash value over time that the policyholder can borrow against? Term life insurance does not have a cash value component. Whole life insurance does have a cash value component. Right. Variable life insurance. So variable life insurance, it does, but variable life is, we could look at whole life. This is like a more broad, this is the best answer for these. These questions are computer generated, but this is like the best answer, right? Because variable life could be a type of permanent insurance where it's like, if it's a variable whole life policy. So that's like a more encompassing term. And then universal life insurance, you can borrow against it, but it's not, it's more of like a cash surrender. So universal life, when you take the cash value, it's more like a surrender, a partial surrender. And it's highly discouraged to take cash value out of a universal life policy, because what happens is in a universal life, you know how the premiums are flexible? Maybe you don't know, but in the universal life, the premiums are flexible, meaning you can pay more or less. So you can pay more than the minimum amount needed to keep your policy in force. That'll mean it stays in force for longer. So what happens in a universal life, typically people pay more upfront. So at the onset of the policy, they're paying more than they need to, so that later on they're not having to pay these exorbitant premiums. So they kind of like prepay it in a way. Does that make sense? Because the cost of the insurance increases every year. So if they're paying $100 a month and the cost is $2 a month, then it goes $4, then it goes $6, then it goes $9, then it goes $13. After a certain amount of time, that increase is going to exceed what the client is paying for their premiums. And when that happens, it starts to take from the cash value to cover the difference. So if someone starts taking from the cash value of a universal life policy, it can result in the policy lapsing a lot sooner than it should. So, um, yeah. Which of the following best describes group life insurance? So, group life insurance is issued to a group offering individual coverage under one contract. So, group life insurance, there's a master contract. Okay. So, the employer has one contract and they issue certificates to people who are employees. Typically, everyone who joins gets should be offered coverage. All right. And it gets coverage. But the employee does not own it. Every state has different laws with converting group life to a personal insurance plan when they leave the job. But it's usually some sort of conversion, like within the next 30 to 60 days of leaving the job, you have to convert it to a individual life insurance policy. Typically, no one converts it though, because number one, they don't read the packets that they're given when they leave a job. Number two, they don't care. And number three, it's too expensive if they do want it. It doesn't make sense. So the group life insurance companies, it's kind of a sham because the only way it's going to pay out is if the person dies while they're employed. So they pretty much have to die of an accident or of like a crazy acute health issue. Because say someone gets some long-term illness, which this country's really good at just keeping people alive for a long time when they're sick. So it's like that usually happens. Someone has to leave work, right? And then they don't have the policy. So it's like, you know, it usually ends up being that they only pay if someone dies like in a freak accident or like really, really abruptly. Okay. Because if they leave, like I said, they're super expensive once they convert it. It's like absurd. So um what's a distinctive feature of universal life? So flexible premiums and death benefits. So it can fluctuate over time. Okay. Fixed premiums and fixed death benefits is like whole life and term. Investment options is variable products and guaranteed accumulation of cash value is whole life. Okay. Cash value is characteristic of whole life insurance. Okay. There's no whole cash value in term life. Group life is typically term, and then accidental death and dismemberment insurance is does not have cash value. Now, I told you whole life endows at age 100. There are endowment policies that you can set up so that it will endow before the age of 100. So essentially, it's like, okay, I want it to endow at age 80. So someone will just end up paying more money into the plan sooner. And then endow means that when they reach that age, the policy is done. The whole life policy is done. So a whole life policy will endow, a permanent insurance policy will endow, typically at age 100, but someone can set it up so that it endows before that. Meaning the policy finishes before that and they get the death benefit if they outlive it. So option to renew, it's called a guaranteed, it's a renewable, it's a renewable term policy. So it allows you to extend the coverage without providing evidence of insurability. So say if someone gets a 20-year term policy, then they're like, you know what, I want to keep the term, then they can just keep the term going. The most common one is an annual renewable term where it goes up a little bit every year. If someone gets a 20-year renewable term policy, they barely ever renew it because at the end of the 20-year, the premium shoots up crazy high. And then it makes sense for them to just get a different policy. All right. So typically with a renewable term, if it's anything more than like 1 or 5 years, people don't renew it. They'll usually convert it to a whole life policy. So if someone has a term, there's a convertibility provision, conversion privilege that allows them to convert the term policy to a whole life policy. A life insurance company would rather you have a whole life policy than a term life policy anyway. It's safer for them because you're going to pay into it for your whole life and the death benefit's less based on the premium that you're paying. It's less of a risk. If someone's unhealthy, they're way more likely to get be approved for a whole life policy than a term life. Okay. What's a key feature of variable life insurance? Death benefit and cash value depend on the investments chosen by the policyholder. All right. Yeah, credit life insurance is not as common. I've never seen anybody actually sell it, but yeah, it's to provide a death benefit to the creditor to cover outstanding debt if the debtor dies. So credit life insurance, sometimes if someone's getting it, the reason why I don't see it is because we don't work with those clients. So sometimes if someone's getting like say you're like a big real estate investor, this is the one thing, and you need $100 million loan from BlackRock or whatever. It it may help to go to them and say, hey, I just got approved for $100 million life insurance policy. So, because that's a big thing. Say someone gets $100 million loan, they're like, what if they die? What's going to happen? What assets are we taking? So if someone's like, nope, I got $100 million life insurance policy for this. They can wrap the premium into the loan, and then the creditor feels a lot safer doing that. Some banks will require people to get some sort of accidental death coverage if they get a mortgage. Some banks want that. Some banks want life insurance and some sort of insurance. Which policy? But you can't. It's called coercion, which is an unfair trade practice. If the bank says, okay, you have to get life insurance to get a loan with us, but it has to be through this company. So if the bank can say you need life insurance, but they can't tell you what company you have to go through, that's called coercion. It's like strong arming you into buying life insurance through a specific company. Okay, so do you guys see like the difference there? They can say, hey, you need life insurance, but they can't dictate which company you have to go through. All right. Which policy is designed to ensure the life of a minor? Obviously, juvenile life insurance. I mean, out of all those, it makes the most sense. What's the advantage of a decreasing term policy? So decreasing term policy, the death benefit decreases over time, which matches the decrease in the insured's need for coverage. So it's like something to cover a mortgage. It like all the courses talk about decreasing term. I've never seen anybody actually buy a decreasing term, and I sold plenty of term life insurance before I sold final expense, and it's not like a thing. Most people don't get decreasing term. But it is for the state wants you to know about it for whatever reason. They really care about it. The people who don't sell life insurance decide what you need to know about life insurance. So what is the option to convert allow a term policy holder to do? Can we just cover this? Convert the term policy to a whole life or permanent policy without evidence of insurability. So you say, hey, you can convert this policy to a whole life without having to prove insurability. So someone can say that example I used previously, where the guy has had a kid and he wants $2 million of term life for 20 years. He could get that, and then in 10 years he may be like, you know what, I want to convert 100,000 of this to whole life so that I can have a permanent estate or whatever. Whole life policy is way more expensive than term for benefit though. What defines a joint life policy? So a joint life policy covers multiple people with a death benefit paid after the first person dies. Survivorship life is when both of them die. I'm pretty sure. I could be wrong, but I'm pretty sure survivorship life is when both of them die. I think it's paid. So survivorship life is cheaper than joint life because two people have to die in order for the benefit to pay out, as opposed to joint life where one does, if that's the case. Am I wrong on that, survivorship life, guys? Okay. All right. Yeah, so joint's cheaper than survivorship. I sold one joint life. I never sold a survivorship life. An adjustable life insurance policy can be characterized, well, I mean, it's pretty self-explanatory, flexibility to adjust the premium, death benefit, and policy term. Universal life insurance offers the policyholders fixed interest rate on the cash value, flexibility in premium payments, death benefits, and the savings element. So universal life, flexible premiums, they can have a flexible death benefit in the savings element. Typically though, If you want to increase the death benefit in universal life, you have to go through you have to go through underwriting again. So say you have a universal life policy, you can lower the death benefit, but to increase the death benefit or to pay less and keep the same death benefit, you typically have to go through underwriting again. Equity indexed universal life is unique because its cash value can be invested in an equity index option for potential growth beyond a guaranteed minimum interest rate. So it's like index universal life. It's got a little bit of a option to grow with a guarantee, but so it's like say the minimum interest rate someone can earn is 2%, and then the maximum they can earn is 8%. So if the market exceeds an 8% return, then the life insurance company keeps the rest. All right. So there's a floor, but there's also a ceiling to it. So it's like, yeah, a variable makes more sense to me for long term. A lot of people push universal or index universal life right now, but the problem as an investment vehicle, the problem with that is that when someone gets into their 70s and 80s, say you have a $100,000 universal life policy. If someone's in their 70s, that policy is going to cost over $50,000 a year in premiums just to maintain. So what happens is someone starts digging into the cash value and the policy crashes real quick and they can have a huge taxable event on their hands. See it all the time. Agents selling these things and they show illustrations that are like, hey, this is if it performs perfect every year. And then someone buys it based on that. And if the market's great every year, which it's not, right? We had a great run, but someone turns 70, 80 years old. It happened with a guy the other day. We had a guy on the phone and he thought he had a $60,000 death benefit. It was $300. His policy was going to lapse in like a month. It was crazy because he got it like 30 something years ago. So, yeah. So if you guys get people trying to push a index universal life on you as an investment vehicle, just know like, hey, if something's too good to be true, it probably is. And life insurance is not an investment either. It's like it can be a savings accumulation, but it's actually illegal to pitch it as an investment because we don't have securities licenses, so or aren't financial planners or advisors. What's the key advantage of group life insurance? So it provides coverage under one contract from multiple individuals. The biggest thing is you don't need a medical exam. So you just join up, you get the coverage. That's fine. Typically employers do it. The employer can write off the insurance as a tax deduction. Okay. And the primary purpose of life insurance is to serve as an investment vehicle. They're right there. Right. So that's a no. It's not an investment. Provide financial support to beneficiaries upon the insured's death. Accumulate cash value for the policyholder. Cover only accidental death. So it's provide financial support to beneficiaries upon the insured's death. So I want to see if anybody here has any questions about any of that stuff. Or anything that has to do with the opportunity here when you start.
I have a question.
Sure.
Hello?
Yes, I can hear you.
Okay. I noticed today that most of the questions are on the types of life insurance, but as I've been studying the course, it covers a variety of insurance.
Yeah, so if I
So that's
covered,
how the test will be?
well, I covered a small fraction of what the exam will be on. I mean, if I covered the whole exam, we'd be here for 8 hours.
No, that was good what you covered. I just
Yeah, yeah.
no, I just was wondering from the time I started the course.
Yeah, so what I'm saying is that the course is on a ton of, you're right, the course is on a lot of material. I just was doing
Okay.
questions on the life insurance part because that's obviously that's like a huge chunk of most of the state's exams. You can look up the outline for your state's exam and see kind of exactly how it is and how it's structured. Typically in your Excel course somewhere, there is something that shows that there's a resource you can look at, like it's a candidate handbook or research, something. It's available right on the page when you log in. You can just look around the little resources. and it'll show you how the state's law, how the state is structured. Typically, most states, Kentucky's weird. I don't know why, but they're weird. They're structured weird. I don't know who else is. Usually, it's 50 base questions with about 30% of those questions being having to do with life insurance, what I just went over. And then there's
Okay.
usually anywhere from 30 to 50 questions pertaining to the state laws themselves. So, for instance, like a grace period in one state may be 30 days, in another state it might be 60. The free look period may be a guaranteed minimum of 30 days in one state, 14 days in another state, 10 days in another state. A minor, someone who's 15 years old in Florida, can sign a life insurance application. In other states, you have to be 18. Right. So like that's why I didn't cover any of that material here, because it would be, it's state specific for that stuff. So all chapters 1 through 10 are the same on all the Excel Solutions courses. It's the exact same. The only thing that's different is chapter 11, which is the state laws. So all the other materials is,
Okay.
yeah, exactly. Like a whole life policy is the same in California as it is in Florida, but replacement laws may be different in California than they are in Florida. Right. So it's like, what do they have to do for replacing a policy? I know Pennsylvania, you have to fill out this like crazy description. New York, we don't even sell in New York because it's just no one sells in New York over the phone because it's such a crazy regulation. So yeah, Robert and Robin Johnson, I'm assuming you're Robin. It talks about you're going to go through your course and you'll see that stuff. But I just covered the life insurance stuff there. There's a bunch of material. There's stuff on underwriting, beneficiaries, policy premiums and proceeds, Social Security, retirement plans. Don't focus on look at your state's outline. But when I was studying, I focused on learning those retirement plans so much. And then when I looked at the outline, it was like 7% of the exam. So I was like, okay, this is like not the best investment of my time in terms of learning. So like for instance, what's Michelle, you said you're in Oklahoma, right? Okay, so I'll show us Oklahoma life insurance pre-license exam outline. So we'll just look here. We'll just try to search around a little bit and see. Um, so your exam content outline. Okay, so this is that's casualty adjuster. Let's see, life insurance exam. Contact the vendor, PSI is the vendor, candidate information, pre-license exam providers.
Sir, I live in New York, and what you said, like we don't sell in New York via the phone.
Yeah, so you'll get we'll get to another state though. It's okay.
All
So
right.
passing your Oklahoma exam. Okay. Uh, so see it says so this life accident, health or sickness. You'll just give the property and casualty. The Excel Solutions has the um outline for the exam on their in their resources. But essentially it'll say how many questions. So I guess Oklahoma is 150 questions and it'll go over the content outline. So it'll help you guys see what you really need to focus on for studying.